Tick on the index is a loss of about 90 odd points, so not looking good. That's on the Nifty.
The Nifty has snapped a 9-day winning streak.
Mid-cap side of things, they are outperforming the index.
Well, the day so far, it started off strong in the green, and then there was a sudden slump in the market about 1:30 p.m., 2 o'clock, and now things are trying to stabilize.
We end another session in the red, but there were plenty of winners in today's trading session. It seemed that some of those defensives, they came back, and they came back in style. The biggest gain on the Nifty was Divi's Laboratory. Hello and welcome to Markets Today, the show where we track around 6 hours of the day's trading action in just 5 headlines. I'm Nigel D'Souza. Here are the headlines for the day. Markets end with minor cuts for the second day in a row as volatility persists, but the mid-caps outperformed the blue chips to end close to around 1% higher. IT stocks, they rise the most. Just Style gains on posting record margins, while Angel One perks up as revenues per client rise. But TV18 slips as profits decline on scale-up of new verticals, and Quick Heal falls after sales dip in an otherwise seasonally strong quarter. In stocks and news, Tata Chemicals tanks 6% on a dip in soda ash prices. BEML rises 2% on reports that its demerged entity BEML Land Assets will hit the market soon. Avalon Techs makes a muted debut on the Lal Street. China's economy grows by 4.5% in the first quarter, beats expectations, marks the highest growth since the first quarter of last year. Crude oil prices see some recovery. Metal stocks do well. The index gains close to around 0.25%. Brokerages bet big on affordable housing financiers, autos, and select pharma firms. On top of the list, Sun Pharma, Cipla, Aptus, Avas, and Canfin Homes, among others. Well, here's what we have lined up on the show for you. In market opinion, we have Adrian Movat of Hong Kong SR and Saurabh Mukherjee of Marcellus Investment Managers. In corporate voices, we'll have Abhishek Bansal of Just Style, and we'll also be joined by the management of Avalon Tech. Well, let's get straight to the day's trading action then. It was volatile day of trade. The Nifty and the sensex, well, they ended a little bit lower in trade. However, the mid-caps, they outperformed the blue chips. That index surged close to around 1%. Media and IT stocks, well, they fared a little bit better. Surbhi Upadhyay joins us to fill us in with how she's seeing trade in today's session. Well, Surbhi, markets in a bit of a consolidation mode.
Well, a very range-bound day of trade with the market in absolute consolidation mode, at least at the headline index level. Neither the bulls nor the bears really managed to make any headway. And that's because, apart from IT, today there were other pockets which were feeling the blues, so to speak, or feeling the reds, if I may say. Reliance, for instance, was under pressure throughout. There was some profit-taking on auto stocks after the recent run-up. Bajaj Auto, Hero Moto, those names were down. Lever was under stress. And banks themselves couldn't really hold up the market. There was a lot of selling in bank stocks around 1:30. So HDFC Bank, second day running after numbers, was under pressure. ICICI Bank was weaker, so was Kotak Mahindra Bank. Pharma is where the money is moving. The Pharma index today was up 1.5%, and it's up almost 5% for the month already. There is an expectation that pharma earnings will be quite good because the pricing pressure in the US market seems to be easing off, and pricing in the Indian market will probably be better. So pharma is where the action is, and also mid-caps. The mid-cap index actually did much better than the frontliners today, and a lot of earnings-specific reaction kept coming in. So good reactions in the case of, let's say, an Angel One or a Just Dial. Poor reactions, let's say, in the case of a Schaeffler or Quick Heal. And earnings really is the litmus test for this market as it looks out for more direction. Over the course of this week, towards the end of the week, actually, we'll hear from Reliance and ICICI Bank. And until then, perhaps the action remains extremely stock-specific and within the current trading range.
Well, thanks a lot for that, Surbhi. Well, IT stocks, they continue to witness a fall after Infosys and TCS delivered weak quarterly results. Market master Adrian Movat, investor Hong Kong SAR, believes that Indian IT sector will continue to underperform.
I think it's logical that the narrower NASDAQ 100 is outperforming the broader NASDAQ composite. It's logical that you're seeing the Indian IT services industry being the wrong side of corporate America cutting costs there isn't a clear sector trend. Now, there might be now an underperformance of the IT service sector, but we can see some trends in other markets, and perhaps that's why you're seeing the sort of relative underperformance.
Getting you some more market opinion, Saurabh Mukherjee, founder of Marcellus Investment Managers, lays out his outlook for the pharma sector. Let's hear him out.
These clients are the world's largest pharma companies. I would say 6 of the world's largest pharma companies, I reckon, account for around 80% of Divi's profits. You speak to them, as we do quite regularly, and they are giving us a very clear picture that America is turning away from China as a source of API. China makes 90% of the world's API. As America turns away from China as a source of the world's API, Divi's is the natural place for them to go to.
Well, moving to the second headline now, Just Dial jumped over 3% on the back of its fourth quarter performance. The company had reported a 5% quarterly growth and margins are at 2-year highs. Rima joins us to fill us in with an analysis on that. Rima, a good quarter for Just Dial, right?
Thanks so much for that. So it's a good quarter from Just Dial. Things are finally recovering and the COVID pain has eased and things are getting back to what they were pre-COVID. So at the top line, there is a 5% quarter-on-quarter revenue growth. Year-on-year, there is a jump of 40%, exaggerated because the base quarter was impacted by COVID, but strong numbers on the top line. Collections are strong, deferred revenue is looking up, and the quarterly revenue at 232 crore in the March quarter is similar to what it was in Q4 of FY20, the first COVID quarter. Margins too at a 2-year high at 14.4%, and the management is guiding for further margin improvement from here on. Cash on the books is solid at 4,000 crore rupees, which the company will use to focus on organic as well as perhaps consider some inorganic moves. The paid campaign growth is at 16,340 crore quarter on quarter, slightly lower than the recent run rate, but the management attributed it to quarterly fluctuations, and the management went on to say the growth from here on will be led by a combination of increase in the paid campaigns as well as improvement in realization.
As we move forward into fiscal 24 and as our revenue converges with our collections for this year, this margin should sequentially keep on seeing an uptick, which is visible in last 2 to 3 quarters as well. So on a long-term basis, I think this business requires 6 to 7% of our top line to be spent on advertising. It could fluctuate a bit on a specific year basis. For coming year, I think anywhere around 35-40 crores definitely we would want to spend. And further increases could depend on how things are panning out.
Well, sticking with earnings then, Quick Heal reported a weak fourth quarter numbers. The revenues dropped by close to around 26% on a quarterly basis. The company also reported an EBITDA loss of around 16 crores in the past quarter. The stock ended with cuts of around 3%, but at one point of time it was down close to around 10%. Rima, you've been tracking this one too. Give us a quick analysis.
Quick Heal has reported a very weak set of earnings. The problem is that they have seen a sudden decrease in IT spending since the second half of last year, and that's hurting business. So revenues are down 26% quarter on quarter, down 52% on a year-on-year basis. Typically, the March quarter is strong. That's when budgets get finalized, spends take place. So normally they have about 100 crore top line growth in the Q4 quarter, but this time it's come in below 50 crore. As I said, the reason is the sudden decrease in IT spending since the second half of last year, and the company foresees the same trend in the upcoming quarter. EBITDA this time is a loss of about 16.5 crore. At the bottom line as well, there is a net loss of 6.6 crore.
Well, moving on then, Angel One also reported its results for the fourth quarter. The stock rallied over 2% on the back of higher revenues, margins, as well as profitability. Surbhi Sutaria joins us to fill us in with the key highlights. Surbhi, a good set of numbers coming in.
Thanks for that. So Angel One is in focus. That is because of its strong Q4 numbers. Now the Q4 numbers were pretty strong given the volatility in the capital markets. The revenues were up 10% at 826 crores. Their EBITDA was up 20%, and this was largely because of lower employee expenses. Employee expenses were lower by 33% sequentially. The margins came in at 45% versus 41%, and the PAT was up 17%. The average revenue per client, that was also up 3% sequentially January at 427 rupees. Looking at some operational data that came in, the total client base was up 10%. The gross client acquisition for Q4 was up 31%. The number of orders, that was up 16% at 26.3 crore orders, and the average daily turnover, that was up 28% at 1.85 lakh crores.
All right, Surbhi, but we can't let you go at that. Stay with us. TV18 broadcast, well, it was down close to around 3% after they reported a big drop in the profitability. The EBITDA as well came in a little bit lower. Give us the key takeaways on this one.
Thanks for that. So TV18 is reacting to its numbers. Now, it's a pretty weak set of numbers. The revenue was down 6%. The EBITDA was down 70% on a year-on-year basis at 77 crores. Margins have come in at 6% versus 17% same time last year. And profits are down 75% at 35 crores. But if you delve deeper into the numbers, the news segment has done pretty decent. The news revenue was up 4% on a year-on-year basis, and the news EBITDA is down only about 12% on a year-on-year basis. The TV news EBITDA on a sequential basis has shown some improvement, and weak ad environment that has impacted the overall profitability. It's the entertainment segment which has dragged down the EBITDA. The entertainment revenue was down 9% at 1,045 crores, but the entertainment EBITDA, that was down 93% at 12 crores versus 180 crores same time last year. Now, the company is continuing to scale up its digital and sports vertical, and because of the investments in these verticals, it is facing EBITDA losses. Key triggers that could work for the stock going forward is the strategic partnership with Reliance, Bodhi and Paramount, which was announced over the weekend. So now they have 15,000 odd crores in their kitty to expand this digital segment. So that could be a key trigger for the stock going forward.
Busy day for you, Surbhi. Thanks a lot for that. Well, moving to the third headline today. Jubilant FoodWorks had climbed close to around 2% on news that Coca-Cola India has acquired 15% in #loyalty, which is an associate firm of Jubilant FoodWorks. The acquisition was worth close to around 105 crores odd. And Jubilant FoodWorks, well, earlier they had close to around 35% stake in #loyalty. That comes down to around 29% or thereabouts. But focusing on more stocks then that were in the news today, Tata Chemicals, the stock was lower in trade. Now, remember, we have brokerage house Kotak Institutional Equities. They continue to have a buy rating on the stock, but the company has slashed the prices of light and dense soda ash by close to around 3 to around 4%. Sonal Bhutra joins us to give us a quick analysis on why that stock was under pressure. Sonal?
Thanks a lot for that. Well, Tata Chemicals is in focus because it is the second price cut that we've seen in the last 6 months. The quantum is around 3 to 4%, not so much, but the indication is that this could continue in the future as well. Now, it's a 3 to 4% cut across their light and dense soda ash products, which is in India only as a geography, effective from April 17th. And this is coming because of the cut that we are seeing in soda ash prices in Chinese market. Additionally, there is more supply coming in global markets. It is expected that Mongolia will see new supply from May 2023. This will make supply easier and will lead to more cuts in prices as well. And that's why there is incremental negative which is expected for the soda ash market as a whole. Uncertainties are remaining around demand and supply, and that needs monitoring as well, and something that could impact Tata Chemicals because 15 to 20% of their consolidated EBITDA comes in from soda ash itself. Now, a price cut should at least partially be mitigated by the lower coal prices, which is a major raw material for them. But the idea is that it has happened now, and there is an expectation of more price cuts, which is putting the stock under a lot of pressure. Kotak Institutional Equities expects Q4 to be strong, which will be led by the US markets. However, outlook for second half is very unclear, so to say, and this is something that they'll be tracking. Soda ash realizations are now correcting after continuous uptick in last 2 years. So that is something which is worrying the street right now.
Got it. Well, stock was lower yesterday and followed up with another downtake. Well, now a couple of other stocks were buzzing in trade. BEML, that was up close to 2% on news that BEML Land Assets, its demerged entity, will hit the markets on April 19th. This listing would pave the way for partial divestment of the government stake in BEML. Vivek joins us to fill us in with a quick analysis and tell us why the stock was buzzing today. Vivek.
Well, absolutely right. So both BEML as well as, the entity that's going to be listed tomorrow are in focus. So first, let's understand what exactly does BEML Land Assets Limited actually own. As the name suggests, it has around 500 150 acres of land parcels, and this is spread across both Bangalore as well as Mysore. Remember, BEML shareholders had actually received shares in BEML Land Assets Limited in a 1:1 ratio as early as in October 2022. So the street has been waiting for quite some time for these shares to be listed. Now, going forward, why is BEML is focused? Number one, this actually clears the deck as far as the government's partial divestment in BEML is concerned. And in fact, the government is looking to sell close to 26% stake. And one of the conditions for the process to move forward was the listing of the Land Asset Bank. So now at the end of the December quarter, the government held 54% stake in BEML, Land Assets Value, as well as BEML. And the market cap, now this is where it gets interesting, the market cap of BEML is at currently just around 5,070 crore. But, as per analysts who have actually gone ahead and done a real estate valuation for the land assets value business, they've estimated the value of the land bank at close to 8,400 crore, which works out to the value of the land assets at between 500 to 525 rupees a share, which is where analysts are expecting this particular company to list at tomorrow. So it'll be interesting to see how exactly the listing happens. And remember also that the stock would be listed in the T2T or the trade to trade segment. So for the next 10 days, it will remain in that segment.
Got that. Thanks, Vivek. Well, we had Avalon Technologies. They had a rather muted debut today. The stock listed at around 436 rupees per share on the NSE, at par with its IPO price. Meanwhile, it listed at around 431 rupees on the BSE. Surbi Sutaria joins us to give us a quick analysis. Well, Surbi, a weak debut for Avalon Technologies.
Thanks for that. So Avalon Technologies made its debut on stock exchanges today, and it was quite a weak listing. The company raised 865 crores, of which 320 crores was the fresh issue and the remaining was offer for sale. Now, most of the money raised is going towards the debt reduction of the company. Avalon is an integrated electronic manufacturing company which focuses on high-value precision engineering products. They provide full-stack product and solution suite, right from printed circuit board design to design and assembly of complete electronic systems. They cater to multiple end-user industries with clean energy, mobility and industrials contributing to over 60% of their revenues. In the 8-month FY23 period, the company did a revenue of 585 crores with an EBITDA margin of 12% and a PAT margin of 6%. Now, in terms of valuation, the company is valued quite competitively. The peers such as Syrma, Keynes, Dixon are valued anywhere between 50 to 100 times FY22 PE, whereas Avalon, which is not too high but still higher than recently listed Syrma SGS Technology at 59 times FY22 PE. Other than that, some other things the street may not have liked is one, their high working capital days. Now, their 3-year average is 90 days, well above the other peers. Second, their declining operating cash flows. They started with 66 crores in FY20 and they ended their 9-month FY23 period with negative 1.5 crores. And lastly, the declining revenue contribution from the top 2 and top 5 customers. So maybe the street is taking note of all of this.
We're looking at it a lot more longer, three-year horizon. What we see immediately is that we will be growing faster than the industry. And since we're just listed, we cannot give the exact numbers out. Our anticipation is going to be faster than industry. We're seeing the orders come in from that. And we intend to keep our 51% and go larger. And the key goal was to give as much as possible as a percentage to the new stakeholders. And that's one of the reasons why the promoters reduced. And some of the other shareholders have reduced much more than what the promoters have done.
Well, time to slip into a short break, but you stay with us. We'll be back in a jiffy with the other headlines that we're tracking for you.
Pull up the flicks and I take it on gear. Pull up the hands and I feel no fear. I dig a don. I sick a don. Take it on the roll and the show and the pull up the flicks and
Volkswagen Virtus, German. This one's a turbo.
1.5? Nice.
The all-new Hyundai Verna. Futuristic, ferocious.
Welcome back. You're still with us on Markets Today. Well, as promised, let's run you through the remainder of the headlines that we're tracking for you, which brings us to the fourth headline today. China's economy grew by close to around 4.5% in the first quarter, beating expectations of around a 4% growth. And this marks the highest growth since the first quarter of last year. Crude oil prices also saw some bit of recovery in trade. Brent held around $85 a barrel. The Nifty metal index as well gained close to around 0.25%. Let's take a look now how the oil and gas sector will perform in the current earnings season. Sonal joins us to run us through the key expectations. Sonal?
Well, it is largely going to be a good quarter for the oil and gas sector due to better realizations, and also fundamentally this quarter is supposed to be better. Remember, crude prices, they have declined sharply, around 19% on a YOY basis, 8% sequentially to $81.2 a barrel. And on the other hand, Singapore GRMs, they have increased to levels of $8.2 per barrel versus 6.3 earlier. And this is something that will show in Reliance's earnings, which will see an improvement led by the O2C or oil to chemical segment and lower windfall taxes as well. Overall, this would lead to an EBITDA increase of 5% on a sequential basis and on a consolidated basis as well for the company. For oil marketing companies, lower crude and higher refining margins will definitely be a positive, but a bigger turnaround will come in from the marketing segment, and that is where improvement will be seen in both the segments and will lead to a 77% sequential surge in EBITDA and 3.3 times increase in PAT according to ICICI Securities. For upstream companies, even though crude prices, they have declined, realizations post-taxes have been around $72 to $76 a barrel, and gas realizations have been stable quarter on quarter, so this will see a set-off. Overall, high other income will aid earnings for oil producers this time around. City gas distribution companies will see a mixed bag where MGL will see the best performance. MGL took sharper price hikes versus IGL, and hence the EBITDA performance is expected to be better. Gujarat Gas will see a weak performance this time around, led by lower demand in the industrial segment. Nirmal Bang estimates that Gujarat Gas will see 26% decline in EBITDA YOY. IGL will see a 12.5% increase, but the biggest rise will be 72% increase in MGL's EBITDA. Now for gas utilities, GAIL and GSPL will see a weak quarter due to supply shortages from Gazprom and also weak demand, while Petronet LNG will see better numbers. That is because of lower spot LNG prices. Leaving you now with the valuations, all producers are still seeing compressed valuations. So around 3 times is what is the number for ONGC. Reliance Industries is at 21.6 times. If we talk about BPCL and HPCL, BPCL still continues to trade at a premium. MGL, which is expected to do well, is the cheapest in the city gas distribution space at around 12.8 times, and the others are higher here.
Thanks for that, Sonal. Well, moving on to the fifth and the final headline today. On to some brokerages outlook. The Nifty Pharma Index has been a relative outperformer in the last 1 month or so. Brokerages like JP Morgan as well as Citi, they are bullish on many of the stocks in the sector. Ekta joins us to run us through a wrap of what brokerages are making and why exactly are they positive in the pharma space. Ekta.
Thanks for that. Well, I'll start with JP Morgan, which is written on the pharmaceutical space. They pointed out that the Nifty Pharma Index is up around 6% in the last 1 month, outperforming the Nifty. Now, 5 reasons according to them, which will drive the sector performance through the year, include the fact that the India business is likely to see the highest price increase this year, aided by one of the highest NLEM, which is the National List of Essential Medicines, revisions. Secondly, for price erosion trends, according to them, they are moderating in the US generics versus the elevated levels that we've seen in the past 2 years. They also see opportunistic gains in US arising on account of increased drug shortages and supply disruption. They are also positive on the fact that there are easing input costs, freight cost normalization, which should aid margins. Sector valuations, according to them, are reasonable at this point in time. The top picks for JP Morgan are Sun Pharma, which has a solid domestic franchise, according to them, and their continued ramp up in specialty. Cipla, continued outperformance in the India business, is one of the reasons that they like that particular stock. Citi has also ridden on the pharmaceutical space, but they are striking a cautious note. According to them, the current optimism around the US generics pricing may in fact be short-lived. The biggest reason behind the continued pressure on generic pricing is factors such as aggressive scale-up by small and new entrants in the US generic space, which remains unabated. They maintain a cautious stance. They maintain that Sun and Torrent are their preferred picks in the Indian pharmaceutical space.
Thanks a lot for that, Ekta. That explains relative outperformance of the pharma industry. Well, finally, let's get you a couple of more brokerage views. CLSA, they're getting constructive on the auto space, and they're betting big on Maruti as well as on Tata Motors. Sonia joins us to give us those details. Sonia?
Well, CLSA put out a note where they are constructive on the auto sector. Now, they met with several clients across different parts of Asia, and the feedback is that most clients are positive on the auto space. There are two reasons for this. One is that stock prices have fallen to attractive levels, and the second is that there is a resilience in demand as well. Now, in the four-wheeler space, they like Maruti as well as Tata Motors, while in the two-wheeler space, Bajaj Auto is their preference because of the dividend yield factor. There's a 4% dividend yield that Bajaj Auto is giving. Now, they also talk about how there are several reasons within, the four-wheeler space. In Tata Motors, there's an improvement in the Jaguar Land Rover business. There's also an improvement in the domestic business, which is aiding Tata Motors. For Maruti, there are several new launches that are coming up, especially in the electric vehicle space. So that is the big trigger. So all in all, CLSA is constructive on the auto sector.
Well, with that, it's a wrap on this edition of Markets Today. Thanks so much for watching.